Good afternoon. My name's David Belbin, managing partner at Glemisall Cummings, and joining me this afternoon is David Bransbury. We've been working together for a long time now in this firm, and I had the great pleasure to work with David's father many years ago. Now, we have two questions often being asked at the moment. The first is, how do I try and navigate this way of getting money out of my business? Is it dividends? Is it salary? And if I'm self-employed, what does that look like and why? Then the other question we have is about vehicles and electric cars. And we've got loads of clients often just saying, now's the tipping point. Should I be, or is now the tipping point, should I be going for electric cars? So David's going to deal with that because he turned up on my doorstep in my office about 18 months ago. And he said, David, I think now's the time. So I said, let's have a look at it. And we did. So David will talk about electric cars in a minute, and I'll talk about dividends and salary now. There's no one solution. There's no one size fits all. And because all of our clients are unique, everybody's got different personal circumstances. The short answer to what I'm about to say is it all depends. And you need really to talk to one of us here as to what will work best for you once we fully know all of the things you're thinking about, maybe wanting to achieve or have achieved. It depends on age. It depends on whether you want to be sharing income with other family members if they're involved in the business, and what their risks might be. But let's start with the basics. So we've got some basic tax bands. I think they're quite well known. If you have income of less than £12,571, you won't pay income tax, and that includes any benefits you might get from your business. If your income goes above £50,271, then you will be paying tax at 40% on anything over that number. And in theory, if you have income in excess of 150,000, you'll be paying tax at 45%. Well, that seems very straightforward, but it's not quite that way, because if you have income of over £100,000, for every £2 of income you have, you lose £1 of personal allowances. So the effect is that between 100,000 and 125,000 or so, you will have a marginal tax rate of 60%. But that's not quite the case either, really, because you're also paying national insurance on earnings, and that will be at 3.25% on any amounts over the 40% band of 50,271. So you'd have a marginal tax rate of 63.25% on that short that £25,000. Then it gets back to 40% rather, and you'll be paying national insurance on that. So you'll effectively have a marginal rate there of 43.25%. And of course, between 12,571 and 50,270, you will be paying 20% income tax, but you'll also be paying 13.25% employees national insurance if you're extracting money as a salary. Now, the alternative to salary is dividends, and if you have £2,000 of dividend income, first £2,000, there's no tax to pay. But thereafter, you will be paying tax at 8.75% of what you receive, which seems a small amount. If you're a high rate taxpayer, so if your income's over 50,271, your income tax that you will pay on dividends will be 33.75%. And if your income is in excess of 150,000, then you'll be paying 39.35%. But you've got to remember that if you own a managed business and you think, well, actually, I'd rather pay those dividend rates than pay the income tax rates, you've got to remember dividends come out of a company after corporation tax has been deducted. So at the moment, corporation tax is at 19%. It's going up to 25%, which means that if there's £100 available for salary or dividend, the dividend route, you're going to take £25 off the corporation tax, and then you've got £75 left to distribute. Now, if you're a higher rate taxpayer and you're going to pay 39.35% of that, then you're not going to end up with a marginal tax rate very different to that you would have if you're a 45% taxpayer anyway. So what is going to work best for you will really depend on what your other streams of income are, what the company is doing with other options of monetary extraction, because I guess the best way to take money out of a company might not be the dividend or salary route. It might be to put it into pension fund, if you can, for some of that money. And there's limits that you can use. So with all of the tax planning advice that we give at Clements Hall Cummings, it is about what's right for you in your circumstances. And yeah, I've just presented some broad thoughts as to what might be attractive, and if you can avoid paying employees national insurance at 13.25%, and on top of that employers national insurance at 15.05%, now that those rates have gone up, then dividends will work, particularly at the lower levels. When you go above, when you become a higher rate taxpayer, it begins to change. When you get over that 100,000 mark, it changes again. And so it all depends on what your business is able to fund as to what will be the right answer for you. The corporation tax rates are going to be at 25% for companies with profits in excess of 250,000. For small businesses, and for many, if profits are less than 50,000, that corporation tax rate is going to stay at 19%. But between 50,000 and 250,000, we're going to be into marginal rates of tax, not this year, but next year when the rates go up. And so anything that your first 50,000 will be at 19%, anything over 250, as I say, at 25%. But if your profits are between 50 and 250,000, you're going to have a marginal tax rate that is going to be something, it's just a little over 30%, I think, just while you're paying catch up. And then at 250,000, you will have be paying £62,500 of corporation tax. My maths is right, or something like that. Which will be your 25% 25% on 250. So that balance of the right mix of income and dividends is going to change depending on where you are. The other things to remember are that with many businesses, and this would be this practice is no exception. If there's a number of business owners and you have director service contracts, then you actually need to be quite careful about minimum wage legislation. So that you need to think about the number of hours you're working and what salaries you might be needing to be seen to draw there if you've got a formal service contract for a set number of hours. And in any joint owner managed business where there's more than one person, you really do need a shareholders agreement, and you probably want directors service contracts as well to protect you should you fall out of what might be a partnership. So that's important. The other things to think about, we talked about other ways that the company can provide remuneration or tax efficient ways to take profits from the business. Well, a tax efficient way is going to be providing a company car that isn't going to cost you an arm and a leg in terms of taxable benefits. And David will come on to that in a minute, but it's part of an overall package. The other area we talk to our clients is when they are setting up a business, is just to consider whether, if they are investing in the business and investing monies that they might have accumulated over the years with their spouse, then why wouldn't you have your spouse or partner as a shareholder in the company, able to receive a return for the risks they're taking? I mean, salaries are often paid for doing the day job, and dividends for as a reward for risk. Now, if you've that is a way of managing the tax burden, and it needs some sensible planning, because you can't be seen to settle money from an earner to a non-earner unless there's some careful thought at the setup of the business as to how and why they have shares. Because the revenue would be turning around, perhaps rightly saying, why is it that by tweaking some shareholdings inside a company is the only reason to avoid paying tax at, say, 60% or 63% if you're a marginal tax, if you're in that marginal rate just above 100,000. So care needs to be taken to make sure that you arrange your affairs in the most efficient way that isn't going to attract a challenge. Because if you arrange your extraction in a way that is too aggressive, HMRC can challenge that. So we just need to be very careful how we do these things. And if you've got, going back to our scenario where you might have multiple owners of a business, you can have different classes of shares because paying different rates of dividends. There's various options. We call them alphabet shares. They can be in place for very good reasons, and HMRC would struggle to challenge those situations, providing they're set up correctly at inception. So those are the areas that I wanted to touch on, because this question, how do I take money out of my company, is so common. The other question we also have is, I'm self-employed, I pay tax on everything I earn, and should I incorporate and become a company? Well, I was talking to somebody the other day, and he has a company, but he's also got a self-employment, and his income is sort of just short of 150,000. And I was thinking, why are you not putting the self-employed income through your company that you already have? He hadn't taken advice before coming to see us, and the amount of taxes paid in the last few years is significantly more than it needs to have been. But so if you're not needing all the income you're earning and you're self-employed, then incorporation needs to be thought about if that works. Also, if you've got some loans for your business, if you are taking money out of your company to pay down debt, then corporation tax is at 19% or 25%, which is a lot cheaper than paying money out of taxed income if you're self-employed and you have some debts that you're repaying for your business, because those are going to be coming out of income that could easily be being taxed at 49% if you include the national insurance and your if you include national insurance and you're a higher rate taxpayer. So just have a careful ponder as to what you want to try and achieve, and then come and talk to us. I'm going to hand over to David now to talk about electric cars. Okay. He's walking the walk as well as talking the talk. Well, that doesn't really work with cars, does it? He's taken his own advice, put it that way. David.
Yeah, David stole my thunder. So yeah, so I am a electric car company, a company electric car driver. Right? Yes, that's right. So let's start. Let's do the first bit. The HMRC do not like company cars, and as I've been in the industry since 1992, and they've always hated company cars. They're taxed based on the CO2 emissions of the cars. The taxable benefit can be up to 37% of the list price of the car, but for diesels, there can be an added 3%. So you can get right up to 40% of the list price. So you can nearly, in 2-3 years, you can virtually be paying for the car. So as well as an income tax charge on the driver, there's a national insurance on the employer. And this is now 15.05% of the taxable benefit. So it's not just the driver who gets penalised, it's the company as well, or the business, because it doesn't have to be a company. This is just for the provision of the car. For free fuel, there's an additional charge on the driver and the company. In my experience, unless the private mileage is significant, it's better just to claim the business mileage. I think I one year worked it out, and it was nearly about 15,000 miles a year, and that's the private mileage. So next slide, please. So should you have an electric car? Well, the whole point is electric cars don't have tailpipe emissions, so they now have a standard 2% rate. This is part of the government's encouragement for electric cars. So on a £45,000 3 Series BMW, I've looked it up, you would have a taxable benefit of 31%, i.e. £13,950. Compare that to a £45,000 Tesla, that would be £900. So that's £13,000 less taxable benefit. So on a 40% taxpayer, that's £5,000 less tax every single year. And when you work out the national insurance on the same car, the company will save £2,000. In terms of free charging, If the employer pays for the charging, no taxable benefit. So typically that is using electricity that comes to premises, or if the company's got an account, pay for the company credit card, pays for the public charging and so on. There's no benefit in card. But if you claim for home charging, you're only allowed to claim for the business mileage. You have to keep a business log for that, and that's fine. In terms of the purchase of new cars, until March 31st of March 2023, this time next year, if the car is a zero emission, i.e. electric, then there's full tax relief in the accounting year. There's a bonus in the year you buy it. For new fossil fuel vehicles or second-hand vehicles, the tax relief is over a much longer period. Effectively, we should get the same tax relief, we just get it earlier. The years ago there was, but there's no special VAT rules on because of electric cars these days. So the normal rules apply. So if you're leasing, you can get half of that cost back. Otherwise, generally, you cannot touch VAT and cars. And if anybody's got any questions about electric cars, I can bore you to death. Thank you.
So, David, I might have a question, just to kick off those questions. If you've got
an Audi that's so old, but no,
don't be rude. If you've got a electric car that's or you're thinking about buying an electric car or asking your employer to supply an electric car, or if you're the business owner and you want one,
you talk about salary sacrifice.
Yep, salary sacrifice. How do you make that?
Well, that's the thing, is that there are a number of benefits where you can pay or have a reduction in your salary for the net cost that the employer cost them. Mm-hmm. So it's the net cost, so that the employer, it saves on their employer's national insurance. Mm-hmm. And you save on the employee's national insurance and the tax. Mm. So say example is that you can say a leasing cost of a Tesla that does lots of miles could be £700 a month. Could be 700, because when you've got a bit of VAT saving, when you've got corporation tax savings and so on, the net cost of the company could be £500.
Yeah.
So that then the deduction from the wages of the member of staff is 500 quid. Mm-hmm. and that gets tax relief. That gets tax relief as well, so that nobody loses out apart from the tax man. So that there's national insurance savings for the employer and the tax and national insurance savings. So it doesn't come out of your taxed income, and that's perfectly legitimate. That's perfectly allowable, and there's certain encouragement by the government to do that.
So, in terms of if you then wanted to borrow some money from a bank because you want to move house and get a mortgage, the taxable benefit or the value of the salary sacrifice would be taken into account somewhere.
Because it would be part of your package.
Yeah.
It would be part of your package. So, and also your that leasing cost won't be shown up in your list of liabilities when you're saying to the bank, "Oh yeah, I've got a mortgage and I've got no loans." Well, that's true, because the loans will be taken out by the company. The lease is in the name of the company. It's not in the name of your lease. So you've got the benefit going, and also, because I've seen this, is that sometimes the banks get a bit shirky because you've got big liabilities to pay for cars. So the car cost is not part of the income and expenditure personally. So
yeah.
So
yes, because and for in terms of having a think through for what's best for the business owners, because they're our clients primarily, and they'll be asking about their employees and doing what's best for them. Just making sure that individuals, everybody understands what all the different tax reliefs are, given that we've got different rates of corporation tax relief effectively on some of those leasing costs. I can see that that's going to make for some interesting conversations, because
Well,
you're
actually,
going to be thinking through, well, actually, if I've got profits less than 250,000, but I then take I have a company car, then the corporation tax savings of that leasing are actually going to be higher than they would be if my profits are 300,000 and I'm having a
I looked it up. I looked up while you were speaking. It's 26.25%.
Oh, that's good.
The marginal rate between the 19% and the 25% is 26.25%. So
yeah, so there's a just trying to choose exactly how you're going to go about extracting money is definitely one with a question with an answer that is, it all depends.
Perhaps it's my minor point on the company electric cars is that the government grant for home chargers has been installed for homeowners, not tenants. Tenants can do it, but homeowners, the grant has ceased on that. But businesses can still get grants, and I think it's at least another 2 years. Businesses can still get grants to installed at their premises. So,
yeah, good. I'm just looking to see if in the chat anybody's got any questions. And if you've got some questions, we can hopefully give you some answers, or we can say, let's come back to you. No questions. Okay, right. Well, I think if we've covered the areas we need to cover, so thank you for listening, and come and talk to us as individuals, and on behalf of your companies, but as individuals, so we can work out something that works for you, to your individual circumstances. Thank you very much.